Well, hi traders, it's that moment that a lot of people have been anticipating, a lot of people have been dreading this situation, but one thing is assured, the market wants clarity, or at least enough clarity from the tariff outcomes that we're going to get from Liberation Day to at least try and price risk and certainty in a much more professional manner, a much more efficient manner going forward. But of course we're trying to price economics, inflation expectations, a further fallout from business and CEO confidence, consumption, growth trends going forward at a time when things are looking quite precarious and people are ramping up the risk of stagflationary environment to play out in the US economy going forward. So of course the outcome of this plays into that narrative, and that's still obviously something that we're going to be looking for. And I will say that once we go past this period of the tariff announcement, we go into a period of negotiation, we're not out of the woods, it's not the end of the story from this moment. We still also have to navigate the ISM services numbers this week, and obviously we're watching that prices paid component relative to new orders, such as we saw in the manufacturing numbers. And again, it plays into that stagflationary narrative that seems to be building. And then we've got non-farm payrolls numbers coming out on Friday as well. Now, what do we know from Liberation Day? Well, we know there's going to be a luncheon that takes place going through the back end of US cash trading session. Donald Trump then will culminate coming through into the Rose Garden, and he'll be speaking at 4 p.m. Eastern time, just on the market close or there and thereabouts, and where he'll be getting a statement under the title of the event, Making America Wealthy Again. So his statement will come, obviously everyone's going to be watching that and people will be reacting very much off the bat to what they've been seeing. Now, in terms of the press speculation, of course, the situation was really whether we're going to get reciprocal tariffs or whether we're going to get a universal tariff rate. Now, reciprocal tariffs would be a lot more troublesome for the market to price because that would involve individual tariff rates set on individual countries, and of course that would make life difficult. Of course, we'd look at different countries and say, well, these tariffs are higher relative to others. That's going to have a bigger hit to earnings, bigger hit to inflation expectation, all those factors playing through. But the speculation on the floors at the moment, certainly we've seen that in the Washington Post and also in the Wall Street Journal, is that we're going to see a universal tariff of 20% across the board, across all countries and across all imports. Now, there is also another school of thought that seems to be doing the round that we're going to get 20% universal tariffs with select countries being carved out and offered a lower tariff rate as well. So maybe some relief coming through there, and it certainly isn't going to be considered to be the dirty 15 nations, where they're going to be tariffed apparently at 20%, which is a pretty punchy number and certainly harder than most people have been anticipating. Now, the good thing for markets, if we were to see a universal tariff rate at 20%, it makes life easier because it's one rate that we can focus on. We can therefore sort of project that into our models to understand what's going to be potentially the hit to economics, inflation, any kind of further fallout playing through, what's going to be the hit to earnings on the respective equity markets, and what's going to be the impact on the currency market. So from that perspective, a one-size-fits-all model would make life a little bit easier for markets to digest and price going forward, and we may see some relief just from that alone. One factor is that market, in terms of certainty, we're also hearing a situation that these tariffs will be implemented almost immediately or as quickly as they can, which is a positive for markets. We wanted to understand that because there was a conjecture around the timeline, the legalities going forward and how quickly that was to implemented. But what we're being told is that they're going to be immediate as well. And also, that 20% level would represent a cap, the highest level. So one would assume this conjecture around whether VAT matching rates would be included. Well, that cap includes the VAT from what we're hearing at the moment. So there is a period that through negotiations that cap could be brought down for certain countries depending on their reaction. So the response from certain nations is going to be very much important. Will they look to counter that with hard-hitting tariffs, in which case we could get in a tit for tat, or will they actually look to lower and negotiate with the US, in which case that 20% rate could come down and represent the worst case scenario playing through. But it's certainly not 20% is certainly not a positive by any means at all. Now, what we can see from the price action is that people have been running down exposures. They've been running a flat position. We can see that in the technicals, where we can see big consolidation in the dollar pairs. Euro dollar, for example, is in consolidation mode. We haven't had a 0.5% percentage change up or down for over 15 trading sessions. We can see cable in strong consolidation mode. S&P futures have been trading sort of 55.80 into 58.70. Nasdaq futures similar sort of tight range playing through. 10-year treasuries 440, 420. So people are going into this situation running a flat position, flat exposure. They've been de-risking and degrossing, and again, people have been wanting to react to the facts that come through. Now, in terms of what we're seeing in market setup, obviously gold is well owned at the moment. I think people who don't run a long position are looking to buy pullbacks. That's been a fantastic hedge because treasuries haven't really been working too well until last Friday. We can see the volatility markets have come alive a little bit, so people are expecting a bit of movement over this. We can see the S&P term structure, the implied volatility for each individual day, does have a bit of a marked jump from the 2nd of April to the 3rd of April. It goes from 23% up to 27%. So certainly you can see a bit of a hedging activity and a bit of bigger expected move there. we can see S&P 1 week implied volatility at the money, trading at a 6-vol premium to 3-month implied volatility for the S&P. So short-term vol has been moving up quite sharply and has reached extremes. Now, if you backtest this situation, since 2022, when we've got to this level of 6-vol differential premium, there's been about 23 different occurrences where we've got to these levels. And if you bought the S&P 10 days later, that you'd be in the money 75% of the time. And if you take that back to 2015, we've had about 93 different occurrences playing through. And if you bought the S&P 10 days later, when we saw this differential, you'd be up 72% of the time. So it has got to a level where people have bought volatility, and that generally means we've sort of got some extreme situations playing through. I'll be watching very much the inflation markets as we go through this as well. Certainly on the short term, we can see one-year inflation swaps, zero coupon inflation swaps have been moving up quite sharply on the back of what we've been seeing from tariffs. You can see that in 2-year inflation swaps have been moving up quite sharply as well. And we'll be watching that one closely, because the outcome from this, if we were to see inflation expectations moving up on the short term, risk could come under pressure. We could see the US dollar having a bit of a rally, certainly against some of the risk effects, and equities could come under pressure. So one to watch very closely in that situation. Also watching what's happening in the swaps market as well in terms of rates pricing, because the market says this number, whilst easier to digest, is going to be really bad for economics at a time we're also seeing fragility. You could see more rate cuts coming through. Now, I'd say that July is only pricing 5 basis points of cuts, so a 20% chance there. Will we see more rate cuts or rate cuts coming out? But the June meeting is fully priced for a rate cut playing through in that situation. We can also see 3 rate cuts being priced by the end of the year, and a terminal rate of 3.46, which is getting ever closer towards that Fed's longer term neutral rate there of 3%. So we're watching that, and I think that's going to be a really clear fallout. So watching inflation expectations, and also interest rate pricing, and also what happens in bond pricing. And I think that's going to give us a pretty clear sense. So the market is under the standing that 20% tariffs are coming through. That makes life easier to digest, but how will the market see this going forward? It's not a good number there as well, but we'll see how the market trades. I feel like the market wants to push high. I feel risk wants to rally, but obviously the market will tell us exactly what happens when we get that clarity. So a big one ahead. Trade at Pepstone.